FS Gojo Mentors, guys, and we back again. Yes, sir. Welcome once again, guys. In this video, you're gonna learn everything you need to know about technical analysis. Yes, guys, after 6 years of accumulating knowledge in the forex market, we're gonna be teaching you guys how to find those snapper entries, how to scalp your trades. Next week, we're gonna be covering sessions, and for this week, guys, we're covering lesson number 4 of the entire free course. Remember, guys, we're giving you this whole 2.0 course completely for free. So make sure you watch the video up until the end. This is Gojo Mentors. Let's go.
Welcome, guys and girls. Now we're going to be looking at the market patterns that we actually look at when you look at the markets. So one thing I want you guys to realize is you need to take clear notes and actually note down every word I'm going to say, because this is clear demonstration of how the patterns look like and how the patterns we actually apply them, so that you can be able to see and spot these different things and different time frames and different patterns to say. So without any further waste of time, let's jump to it. So pattern number 1, a consolidation channel. So a consolidation channel, it looks in this nature. As we have taught you guys that there's an impulse move and a correction. We know there's an impulse move, a correction, impulse, correction, impulse, right? But however, a consolidation channel is in this sense. It's a ranging market that is going on the right hand side, sideways, right? So this is a manner of, it's creating a high buy opportunity or high sell opportunity. This means that this is when the market is breathing. This is when the market is taking a break from impulses. So in this sense, guys, a consolidation channel looks something in this nature. So we would have a push to the upside and then consolidate sideways, creating a structure in a sense of a rectangle shape. As you can see, in a sense of a rectangle shape, it will look something like this, because the market is ranging only in between this rectangle phase. We know that we support low and we resist high. So it will just play around this rectangle, forming a continuation pattern. Just remember, guys, a consolidation channel that occurs after an impulse move and it's in a format of a rectangle shape, just understand you're gonna be looking for continuations to the upside or the lower side, right? So in that bearish market, we would look something in this nature. We would have a push to the downside and then consolidation sideways, creating the nature of a rectangle shape right there. And then we know that we're going to be impulsing again if we break out to the structure to the downside. As we know that the market nature, it's a push to the downside, correction, and then push again. So that's the nature of a rectangle, or to say a consolidation channel. So in the bullish market, it will look something of this nature, push to the upside, correct sideways, creating something in nature of a rectangle shape. We know that we support low and we resist high before we actually get confirmations to push to the upside. So that is what you need to look for, guys. But however, remember something, it's not always a perfect picture that you will always have with regarding the markets. You always need to read in between the lines of how is it presented. Is it presented in a shape that we're looking for continuations, or is it represented in a shape that we're looking for reversals? Sometimes the consolidation channel might be in this sense. You know, we're correcting sideways, but sometimes it might push up, push down, go back in the same way. So you gotta look, guys, this might be acting as a head and shoulders. So be actually sure that you check on these things and dwell deeper into what's presented by the charts. So all right, guys and girls, we're going to be looking at Euro USD. So as we said, we're looking for what? A continuation pattern, which is a consolidation channel. So without any further waste of time, let me just copy this bit of price right here. Just copy it from this sense and then put it right there. And then as we copy it aside, you're going to be able to read in between the lines. As you can see, this was an impulse move. This was a correction, as you can see. Then impulse again. Now we're having a correction. As you can see, it's pretty clear to understand these things. So now we're gonna spot our rectangle shape. What do? We don't see any in between these lines, but however, I'm seeing some bit of price right here. Let's just go to a 4-hour time frame. As we drop it to a bit lower time frame, I want you guys to see something or spot something. So we actually having a bit of price right here, right? As we're having a bit of price right here, remember I said you gotta be able to read in between the lines of what's presented by the charts. As we can look closely here, this is a correction in a phase of a rectangle shape. But however, look at what's happening. It didn't continue to the downside, but however, it reversed to the upside. Look what happened. If we look closer to the market, we had something in nature of a head and shoulders. but however, it's not quite presentable. That is why we say it's important for you to read in between the lines, right? So you can see that it already pushed up. But imagine if we had a high push to the downside and then we corrected to the lower side. It was going to be actually a nice way to actually say this is an opportunity for us to look for continuations. But however, let's look at the bidder price. So as you look at the bidder price, guys, you're going to see that this is in nature of a rectangle shape, right? And in nature of a rectangle shape, inside we also experiencing some patterns within. As you can see, we're experiencing some patterns within. And also here we're experiencing some patterns within. You're going to learn about these patterns, guys, as you delve deeper into the pattern side. As you can see, so the real nature says we have a push to the downside, correct sideways to get those confirmations before pushing to the downside. Now, this was the one where I was explaining that sometimes, guys, doesn't open up, or it doesn't look at the bigger picture, or it's not presentable in a perfect picture, that we gonna be looking for continuation. But however, you just gotta be able to read in between the lines. As you can see, push, exhaustion, and then we had another push, guys. It corrected again. So this is telling you guys that it's failing to break below to retest and give us continuations. But however, it's ranging in between this rectangle shape, right? So that's the failure of the consolidation channel, but not a sense of failure, but it's a possibility that you always gotta look for. However, a consolidation channel occurring in a rectangle shape, it needs to be the one that you look for continuation patterns. But however, it's not gonna be always in a clear picture. You just gotta be able to read in between the lines. So now let's focus on some bidder price right here. As you can see, we having that bidder price saying a correction that occurs in a rectangle shape. Let's copy it and put it aside. As you can see right here, we're ranging in a rectangle format. As you can see, if I copy this price right here and then just demonstrate it right here, you're gonna see, guys, this is clear, beautiful. That is why the mid time it broke to the upside, we literally continued to the upside. As you can see, this was a push to the upside, and then this was a correction, and then push to the upside. This is a correction, right? So these things, guys, are pretty clear to look for continuations. But let's look at it in the real market. So as we put it right here, guys, you're gonna see that this was a correction format. As you can see right there, this was literally a rectangle shape, because we know we resisted high and supported low, resisted high, supported low. So it failed. That the meantime it broke out of the structure. Look what happened. It literally broke out, retested, and continued to the upside. Now it's creating another format of a rectangle shape, which is a consolidation channel that is ranging in between, guys. As you can see, if you look closely inside here, we're still having those pushes to the upside, corrections, and then as you can see, push, correction. But however, we're in a consolidation channel here, of which we're looking for something in this nature. If the market pushes up, it needs to consolidate or maybe give us a correction to retest the level of support and then continue to the upside. But however, I'm definitely sure now this makes sense. A consolidation channel is something in nature of this. It creates a rectangle shape, and then supports low, the equivalent, as you know, guys, support low and resist high before looking for continuations. So guys, that is it for the consolidation channel. Let's get deeper to the next pattern. Pattern number 2, falling wedge or a rising wedge. So guys, these are the most sensitive patterns to trade, because they literally sometimes they're medium probable patterns. Sometimes they occur to make you profit from the market, but sometimes they occur to trap you inside the markets. But the nature of them, they would look like this. So in a bullish market, we would look at something like a push to the upside, correction to the lower side, forming a channel that is actually going to the lower side or on the downside before actually continuing. But however, the nature of them, guys, doesn't always occur in this nature. Or maybe on the bearish market, they would look in the sense, push to the upside, create a rising wedge to going to the upside. It sometimes looks steepy, you know, like it looks steepy like a mountain, or neither, yeah, the same as a mountain. Then it will push to the downside. But however, looking closely to it, guys, they might be trapful because they act in this sense. So as I've said, guys, the reason why they are so trapful, it's because they normally do these things. So the market would be actually pushing to the upside and then correcting sideways, going on the lower side, or neither going to the support. But then only to find out that this guys is acting as a trap. Sometimes the market prefers to do this. The market would push to the upside, corrects to the lower side, and then continue to drop. That's why we're saying these steepy ones are not the most high probable, but they are medium probable, it doesn't mean they don't work. So the only time they would work is if the market pushed to the downside, corrects to the upside, forming a rising wedge to retest something, maybe to retest a resistance or to retest support, right? That's how they become high probability. But normally the market would push to the upside, correct sideways, going to the lower side, forming a falling wedge for continuations to the upside, only to find out that it will break the structure that you have created. Let me just cater for it right now. Break the structure that you have created to actually continue, go low, retest right here and drop. So that's how, guys, they become so trapful. But however, we're looking for continuations when you look at this pattern, but don't just focus on what you know. Focus on reading in between price action. That's the most important thing. Or maybe in the bearish market, they would look at something in this and they push to the downside, correcting, forming a rising wedge, right, guys, before actually continuing. So this strategy, the best thing about it, guys, it makes you wait for the markets. Imagine if you say you sell at the current price right there, and then the market decides to go down, respect this level, and then continue up, break out the structure and continue to the upside. What's going to happen? You actually set yourself an unnecessary losing trade. That's what I'm saying, guys. You gotta read in between the lines. It becomes more clearer if it has something to retest on. So for instance, on a bullish market, it would do this: push to the upside, forming a falling wedge, right? And then create a structure. As you can see, create a structure. Maybe if we have a support zone right here, it might most probably come back, retest and push, break out, retest on the structure that has been created above. After retesting, that's where we put in our buy stop. It triggers us, we are in profit. And then in a bearish market, it will look something in this nature: push to the downside, forming a rising wedge, and then creating that pattern we're looking for. Wait for a breakout and then retest. That's when we enter, and then we're gonna be in profits. We gotta say reading in between the lines, because reading in between the lines will help you to spot these breakouts and retests, to spot continuations to the downside. But however, this is a continuation pattern, guys, and don't make it your main priority, because it normally doesn't work. It works most probably 60% of the time, but it's a pattern that we needed to share. It doesn't mean it doesn't work, guys. It literally works, but it's just that medium probable pattern to trade, a rising wedge or a falling wedge. So let's look at the real markets to actually see and spot these things. All right, guys and girls, we're gonna be looking at GBPUSD. So on GBPUSD, we're actually seeing something in nature of what we have already spoken about. Remember, guys, I said to you, a falling wedge comes from a bullish market, right? Look at here what happened here. We had a push to the upside, right? And then correction going on the lower side, forming that falling wedge, and then it continued to go up. Now, let's look at what happened after that, right? What happened after that? Look what happened. The market literally pushed to the upside and then created a bigger picture of a falling wedge, but it never went to the upside. That is what, guys, I said, be careful about. It sometimes catches you on the wrong side of the market. Look what happened. When the market literally created this structure, right here, as you can see, literally created this structure. Look what happened. It literally caught a lot of people on the wrong side of the market. But if you are able to read in between the lines, you're gonna be able to spot that this was a fake out to catch people on the wrong side of the market. But what do we do? Remember, guys, I taught you about evolving, emitting markets, right? Literally emitting trend line. So if you put it right there, you're gonna be able to spot this was actually a trapful pattern to say, because what happened, a falling wedge occurs in a sense to respect, or to say to confirm continuations to the upside, the same way as it did right here. As you can see, this was a falling wedge right here. Right here, it was a falling wedge. As you can see right there, guys, it was a falling wedge. It was going to the lower side, but look, it went on the lower side to respect the structure. Can you see that? This was a lower structure, guys. This was a resistance. It broke out, came retest to respect the support. And what I said is, it only becomes high probable if it has something to retest. This had nothing to retest, right? As we can look close, if we drag it to the next side, it literally respected the previous support zone. As you can see, there's a support zone over here. It supported over here, but however, it also had something to respect at the top right there. As you can see, that is why it failed to literally break to the upside, but actually trap people on the wrong side of the market to tell them that we're looking for continuations. But however, it wasn't, guys, a continuation. That is what I'm saying. These patterns are literally one of the most sensitive, because you gotta be careful how you trade them. You're not just gonna trade them for the sake of having trades running. You gotta be careful because they are most trapful, guys, right? So we have looked at the falling wedge. Now we looked at the beautiful side of it, and then on the trapful side of it. This was the beautiful side of it. A push to the upside, correction, forming a falling wedge, and then it continued. Now this was the trapful one. Push to the upside, correction, trapping people on the wrong side of the market, and then it dropped. This, guys, was a drastic drop. If you can look closer, it was a drastic drop. So that's how we trap people on the wrong side of the markets. So let's look at another different pair. Okay, guys, now we're going to be focusing on USDCAD. So we have already explained how a falling wedge looks like. Now it's time to explain how the rising wedge looks like. So a rising wedge, guys, occurs in this sense. So we're just gonna copy a bit of price right here. As you can see, I said a rising wedge occurs better if it has something to retest, right? So a rising wedge is in this sense. So as I see it, let's just copy a bit of price right here. Right, before, let's just copy this bit of price, put it right there, and then just make a sample about it. As you can look closely, I said the nature of a rising wedge, it will look in this nature. Push to the upside, correction towards the upside, and then looking for continuations to the lower side. However, it's not always picture perfect, because these patterns sometimes can trap you. So as you can see, we had the first rising wedge over here, and then we had the second right here. We had the second right here, and then these were normal consolidation or rectangle patterns, as you can see. So we are not there. So these ones became the most high probable. Remember, I said when it comes to these patterns, you gotta be able to read in between the lines. It has to have something to retest. So as you can see, the reason why it turned right there, it had something to retest. We had a push to the upside, as you can see from here, push to the upside, correction, forming a double top formation, push to the downside, correction, forming a rising wedge to create a triple top right there, and then it pushed to the lower side, came back, had something to retest, push to the downside. So guys, this was the most beautiful one to spot. A rising wedge needs to have something to retest. Push to the downside, correction upside, and then something to retest. Actually, what? A resistance zone, as you can see, retest the resistance zone before actually pushing to the lower side. However, a rising wedge and a falling wedge, they are both for continuation patterns. On a bullish market, we're looking for a falling wedge. On a bearish market, we're looking for a rising wedge. So let's just look at the bidder price right here. That was most trapful. So guys, now we have found a bidder price, which you're gonna copy this one, and right there, just put it lower side right here. So guys, let's look at this price to actually make sense. So the trapful side about a rising wedge, it occurs in this nature. Remember the nature of it, it looks like this. Push to the downside, correction to the upper side to retest something before actually continuing. But however, in this strategy, we use stops. We don't use market execution. But sometimes we do use market execution, but not always though. But yeah, you're gonna learn about these on the entry lesson. So what happens when we're looking for this bidder price? So as you can see right here, guys, we had a rising wedge from the push to the upside, right? And then when you hit a rising wedge, we always have something to retest on. But however, this is where evolving comes in. Look what happened in the real markets. We had a push to the downside, obviously creating a rising wedge. Imagine if you were to sell right here. The market was going to be trickling. It kicks you out, then you're out of the trade. And then you start saying, the market doesn't respect my setups, the market doesn't favor me, and etc. But you just got to be able to read in between the lines. So the rising wedge, the trapful side about it, it occurs in this nature. So the market had a push to the downside, correction on the upper side, forming a rising wedge. But however, look what happened on that rising wedge. The market literally created a correction within a correction. So this was a correction, it also created another correction. And remember, the market, if it trickles a lot, it tells you that it's forming a different structure. That is why, guys, we needed to evolve. Look what happened. These could have trapped people in the wrong side of the market, but if you read in between the lines, you were going to be able to spot that now it's creating a falling wedge, which turns this rising wedge an impulse, and then this is a correction. So you're going to learn also about how the market price action tends to tweak or change. So if this was an impulse move and then this correction also corrects in the corrective format, forming another correction within the correction. This was a correction, but now we're actually forming another correction, which becomes more confusing to actually learn how to read in between the lines. But as I said, the only way you can do this is you being able to read in between the lines. So as we read in between the lines, we were going to be able to spot that, okay guys, so now our trend line to support our rising wedge failed, right? As it failed, we need to what? To evolve, right? Evolving or emitting structures. As you can see right there, this failed. This means now, guys, we needed to evolve to put our structure right here. Now it created what? We can see it created a bigger picture of a rising wedge. So this is a bigger picture of a rising wedge. Push to the downside and correction to the sideways. Push to the downside, correction. It broke out, came back to retest and dropped. That is why, guys, I said to you, it's important to look at the breakout. For it to be high probable, the breakout needs to be impulsive to have a retest. But if ever it breaks out correctively, it's telling you that now the prices are literally changing. As you can see right here, guys, the push was on the downside. It corrected sideways. But however, in these correction, it literally broke out the structure correctively, telling us it's changing in price, creating another format of a pattern, which is what? A falling wedge. Now, this correction turns into an impulse. This was an impulse. This was a correction that continued to the upside. That is what's the importance of reading in between the lines. Remember, guys, read in between the lines. That's going to help you to understand the evolving and the emitting of patterns. So that's it for the rising and falling wedge patterns, guys. Let's get deeper to a different pattern. So we're going to be looking at the third patterns, which is a descending and ascending channels. So these ones, guys, are the most high probable patterns to use, or the patterns to look at the markets, because they present a high opportunity of capitalizing from the markets. Guys, these are the most favorite and you must include them in your trading plan. But now let's focus on the nature of them. So the nature of them, they would look like this. So on a descending channel, we would look something of this nature. The market would push to the downside and then correct also to the downside. The reason why these patterns occur to the downside, or corrections occur to the downside, it's because these act as a confirmation for either reversals or continuations. But in this sense is reversals. So the reason why it's a reversal, guys, remember, when prices are about to continue, they literally would correct sideways. But sometimes when the correction occurs going to a structure or approaching the lower side or the upper side, as I'm explaining now, a descending channel, they act as part to tell you that the prices are now oversold right here, because this is a what? This is a descending channel, right? As this is a descending channel, it literally looks something of this nature. This is when we are looking at the bearish market, right? So they would literally push to the downside, right? Correct sideways, actually go into the lower side also. Imagine, how can you push to the downside but also correct to the downside? It's a confirmation of a reversal pattern. This means that the prices have been oversold. Now, looking at the bullish market, it will look something in this nature. The market will push to the upside, correct to the upside, because it's telling us now the prices are literally overbought. So this is why these things occur, or these patterns occur, to tell us that now the market has been overbought, to actually look for what? Reversals. But it depends on what the market is actually approaching with these corrections. Actually, it needs to approach a zone, which is a resistance zone, for you guys to be able to spot that retest, right? And then break out, retest, and continue to the downside. That's on a bullish market. So now let's focus on the real market for these patterns to make sense. As we're looking at USDJPY, so we're going to be able to spot these things, guys. Remember, I told you that there's inner structures, outer structures, etc. So you're going to be able to spot and learn about these things, guys, especially when it comes to the real market. So let's just copy a bit of price and create our outer structure right there to know what we're looking for inside the market. So let's create our outer structure right there and drop it to a lower time frame, which is a 4-hour time frame. So you dropped it to a lower time frame, which is a 4-hour time frame. You're gonna be able to spot these things. As I said, we have what? Ascending channel. So the market will literally correct towards the upside. So let's look closely to the bidder price, right? So let's look right here, guys. It's gonna make sense. So these patterns also have those trapful side about them, but however, they become most high probable if you focus on reading in between the lines. So let's look at this bidder price right there. So you can see this was what? An ascending channel. As you can see, this was an ascending channel. The market had a push to the upside, but started correcting towards the upside, which retested the previous high, which is our what? Our resistance right there. And then look what happened when it literally reached this level. After breaking out, retesting at this level, it really dropped to the downside. And then it created another ascending channel to form a double top right there and respect the previous high, and then it finally dropped to the lower side. So that's an ascending channel. So a descending channel will look something in this nature. The market had a push to the downside, as you can see, and then it corrected towards the lower side. After it broke out, it came back to retest, and then it shooted up, right? So you can see, let's look closely to what's actually happening. Look at this bidder price right here. Now let's cater for it as if we're looking for a signal. As you can see, we're gonna cater for these. Many touches literally confirm a high probability. So as you can see over here, this was a descending channel which came to retest the support zone, and literally it shooted up. As you can see, boom, it went up and then it came back, right? That's for a descending channel. So let's look at another examples, guys. Remember, the more the examples, the higher understanding you will have. So let's look at the current market right here on what's happening on the current prices. As you can see, we literally had a push to the downside on this price action, boom, to the downside, and then the market started now correcting towards the lower side, which gave us a confirmation of a reversal. That's why the market literally pushed up, corrected, and continued to the upside. That was because it was a falling that was because it was a descending channel. That's why I'm saying these ones, guys, are actually one of the most high probability patterns to trade, because they confirm reversals, right? So let's drop it to a 1 hour time frame. It will make sense. So as you can see, if we cater for these patterns, you're gonna be able to spot that why did these become a high probability trade. So you spot these things, you're gonna be able to see that we formed a descending channel over here. This is a descending channel within a descending channel. As you can see, also over here, we're having a nature of a descending channel to support our descending channel, push to the upside, retest, and continuation. So guys, these are the most important expert factors you need to understand and literally look at. So if we look at the current market price, what's happening right here? It's a what? This is an ascending channel. An ascending channel, as you can see, the outer structure on a 1 hour time frame would be something in this nature. The prices had the first touch, second touch, and the third touch, right? So it had these touches. It confirms to us what we're gonna be looking for, something different. As you can see, if you drop it to a 30 minutes time frame, you're gonna be able to spot that at this current level, we created a nature of an ascending channel, right? This was an ascending channel that literally, when the market broke out of the structure, it literally dropped. That is why, guys, we say these are the most high probable. It only depends on what is approaching. But as you can see, this was a what? A resistant structure. That was why it came to retest and literally dropped. So these ones, guys, are the most high probable. And guys, we literally love these patterns. If you learn and practice them, guys, after this lesson, you need to go back test these patterns. You're gonna be able to master them. But let's now look at another bidder price. As you can see, we also had our support right here. As you can look closely here, guys, we had a push to the downside, as you can see, but now we corrected sideways to form a descending channel that literally, when the market broke out, we actually continued to the upside. And also here we formed an ascending channel, of which when the market reached the top, we actually dropped. So these guys are the most high probable. An ascending channel occurs in a bullish market to retest a resistance zone or to confirm a double top. A descending channel comes from a bearish market, whereby we would have a push to the downside, correct to the lower side to retest a support zone, break out the structure, retest, and continue to the upside. That is the difference between an ascending channel and a descending channel. An ascending channel is on a bullish market. The descending channel is on a bearish market. So let's go to the next pattern. Pattern number 4, expanding channels or expanding patterns. So these ones, guys, are also one of the most high probable trades, and literally we can capitalize from them a lot, because this is when the market is now starting to create a bigger picture of a pattern. Do you get what I'm saying? So it's actually that structure that creates a bigger version of a pattern. So the nature of it, they would look like this. On the bearish market, the market will push to the downside and then correct sideways, starting from small prices, expanding to create bigger version of a correction. So they would look in this nature on a bearish market, right? So they will look in this nature on a bearish market. It creates an expanding channel. Remember, expanding, guys, means enlargement of things. So expanding channel is when the prices are creating a bigger version of a pattern. And then on a bullish market, it will look something in this nature. A bullish market, it will push to the upside and then start small and actually create a bigger version of a pattern, of which it's gonna look something of this nature, because it's the nature of it. So the most important thing, guys, is to be able to read in between the lines. So this is one is the bearish market, and this is for the bullish market. So the trick side about it is that you can either choose to use a bit of both, in a sense that you can also use market execution and you can also use stops. But in a bigger time frame, we don't prefer using stops or maybe orders. We prefer using executions on smaller time frames. Then on a bigger picture, we actually look at how is the prices moving at the current state. So the most important thing, guys, is that these patterns can either occur on a bigger time frame or a lower time frame. If they occur on a bigger time frame, it becomes a high probability for you to use market execution, because when you drop it to a bit lower time frame, you're going to be able to spot patterns within patterns, of which sometimes they look in this type of nature. So in a bearish market, this will be the push to the downside, as we explained, push to the downside, correction, creating a bigger version of a pattern. But then for continuations, it will literally push to the downside and then correct towards the upside to respect the previous zone in this nature, right? Correct in this nature to create a version to retest the level and create maybe a double top formation on a bearish market. Remember, a bearish market, something like this. We would actually know that reading in between the lines or the key factors of the market, we would know that it will be most high probable to literally wait for the prices to break out of the structure right here, come back to retest before actually going short and capitalizing from this trade, before actually going short to capitalize from this trade in completion of the expanding channel. Because we know the prices immediately they come here, they respect, they come here, they respect, they come here, they respect. So we anticipate that since, well, this is a correction, the prices are also going to respect to confirm a double top formation before actually giving us a clear version of the lower side. So that's the most important key factor to understand on these, especially on the bearish market on an expanding channel. So let's look on how the bullish market would look like. So in a bullish market, the prices would push to the upside and then expand, creating a bigger version of a correction. But then the lower side, now when approached, they will trickle a lot. Trickling means when prices are giving small moves to respect a structure. As you can see, this would be an expanding, because you look closely to it right there, and also we are also supporting there at the lower zone. And then within it, we also have a pattern of which is in this nature. We have a pattern of which is in this nature. As you can see, we would literally wait for the market to actually break out of this structure right here and then give us a clear version of a push to the upside, break out, retest before actually looking for our buying opportunities to capitalize from this trade and then push to the upper zone. Because we have understood that every time prices touches these lines, they literally respect a lot. Every time they retest, they respect a lot. So especially now that we have a double confirmation that we have a support zone which has been respected, and then we have a correction phase that we have been going through when prices were creating a trickling movement where there is no high volatility. Remember guys, on an expanding channel, if it's only impulse moves, that's when you're gonna be able to look for breakouts and actually trade a bigger version of it. But if ever the prices are creating corrections within the expanding channel, you can capitalize from that. But now let's look at the real market for these patterns to make sense. So guys, we're gonna be looking at GBPUSD for an example of an expanding channel on a bearish market. So on a bearish market, you can see guys, we're just gonna take prices back from here. As you can see, you're gonna learn how to use this replay button once you have subscribed with TradingView. So let's just cut prices right there and then just come back here. So this is the bigger version. Remember what I said, on a bigger time frames, it confirms that you can capitalize within those small movements. So if we cater for the outer structure, we can see that this was the resistance, and then below this was the support, right? And below this was the support, right? Let's just take it a bit back right there. This was support. So let's drop it to a 4-hour time frame. If we drop it to a lower time frame, you're gonna see guys, I said the nature of it will have a push to the downside, start small but already creating a bigger version of a pattern. So this was a bigger version of a pattern, but you can see within there we're experiencing what? We're experiencing patterns. This was pattern number 1, which is what? A rising wedge. This was pattern number 2, which is a rising wedge also, and then this was pattern number 3, which is an ascending channel to form and confirm a what? A double top formation. So guys, you've got to learn to fall in love with the markets once you master these things. So that's why I'm saying you need to backtest, to read in between the lines, right? Sometimes these pairs or these patterns literally help each other for you to create a high probability setup for yourself. So this is an expanding channel. So what's going to happen right here? I'm going to cater for the lower zone right here because we are looking at the current market price, right? As you can see, this as an expanding channel, I wouldn't want to wait for a breakout to break out of this current zone because it's going to be a high risk. Imagine guys, if I enter this trade and then my stop loss, let me say I enter here and then my stop loss needs to be 300 pips. Guys, we don't trade like that. We have small risk but bigger targets. So in this nature, this is what I'm going to be looking for. This was the first touch, second touch, and now we are waiting for the third touch. Let's play prices bit further, bit further. Now the prices literally respected the level. Now it's time to now spot where we're going to put our sell stop. So we're going to say the prices have reached the top, which might be our third touch. So we're going to be looking for a breakout, which means we're going to put our sell stop right here. You know, we're going to put our sell stop right there. But then let's drop it to a 1-hour time frame for it to make sense. So if you drop it to a bit lower time frame, it's going to give us a clear version of where to put our sell stop, because the lower the time frame, the bigger picture or the bigger version you have of the setup you are looking for or the pattern you're looking for. So as you can see, it's patterns within patterns. Also within this expanding channel, we're also experiencing something in nature of an ascending channel. So you can see first touch, second touch, third touch, confirmation, right? And then we're gonna say we're waiting for prices to break out this structure, and then we're gonna put our stop loss right there to wait for the prices to go a bit lower up until that level. And let's look closely to what's happening. So let's play price. As we played further, you can see the prices are starting to drop quite nicely, right? So it dropped quite, we are triggered in. Now, as you can see, we are triggered in the price. We are having a pattern within a pattern, which is an expanding channel, but within it, we spotted a pattern, which is an ascending channel. Now let's capitalize from it. As you can see, as we play prices, they're starting to respect. They push lower, they push lower, they keep trickling. Now, this is what we call the rectangle pattern that I've shown you. That guys, after a breakout, we expect the correction to confirm or create high influence of buyers and sellers to literally tell or push the market towards the anticipated direction. So as you played further, you're gonna see it's starting to respect. You see, starting to respect, starting to respect, starting to respect, starting to respect. As you can see, it's creating a bigger version of a correction. But however, we're still within this trade, guys. Imagine you could have held this thing up until when? As you can see, we are profiting from it. We are profiting from it. Profiting. So when the market has now reached this point, that is when we guys tend to put our stop loss on break even to protect profits, because we don't like taking unnecessary profits to the markets. So it's important to secure your profits and literally put them safe. So we're just gonna play this thing. As you can see, it keeps on playing, keeps on playing, keeps on playing. We are capitalizing from this trade, guys. Imagine we could have held this and literally profited from it for quite a lot. If you can look closely, how much have we banked right now? Let's just pause the price action. So we could have banked ourselves 1% of, let me see, 1%.12, but our stop loss is on break even. Now let's drop it a bit lower to this zone, right? So now our stop loss is now here, right? Our stop loss is now here. So let's play it further to see what happens. So as you play it further, you're gonna see, guys, we are capitalizing from that trade a lot, because why? We read in between the lines. So when the prices does this again, we're gonna see that this is also a correction, right? And what do we do on corrections? You're gonna learn about scaling in also, guys, how we scale in within the market by reading in between price action. We're gonna also enter the trade right there. I'm gonna also enter the trade right there, have a bit lower risk right there, and then wait for prices to actually play within, right? As we wait for prices, you're gonna see it breaks out. No, it didn't trigger us in. It triggers us in now, and then it continues to go down. You see, guys, we could have capitalized. Imagine we're still holding that trade and also holding this one, so we capitalize from the trade. Now let's go to a bigger version. As we go to the bigger version, you're gonna be able to spot that right here we had our support zone, of which you're expecting prices to reach this level. So let's let's secure profits. We put in our stop loss right here, and then we drop this one right here. Now we have, on the first trade, we have 1%.48, and then on the second trade, we have already secured some bit of profit. And then as we played further, it keeps on playing and respecting our setup. Can you see that, guys? Now, this is how we actually swing trades, by reading in between the lines of expanding. So even on an expanding on a bullish market, it will look something in this sense. The same way as we look at it in a bearish market, they would look the same. So as you can see, this is a clear version of how to trade an expanding channel on a bigger version. But sometimes it actually occurs on small versions, and actually it creates something in this nature. Push to the downside, correction, creating an expanding channel that you just gotta put your sell stop below and put your stop loss above, and then when it breaks out, it triggers you in and you're gone. But that's the nature of it. But if ever it's in a bigger time frame, you gotta be looked to capitalize in between the lines. You gotta look at patterns within patterns. So that is it, guys, for an expanding channel. Now let's look at the next pattern. Hello guys and girls, what's good? This is FX Code, your mentor. Welcome to the FX Code Advanced New Market Strategy. Guys, this one is gonna be one of the bombest that you have ever experienced. So guys, without any further waste of time, let's jump to the true principles of what the strategy implies. The nature theory of the strategy. The market moves in phases. We all know that, right? Impulsive phase and a correction phase. These market phases create higher highs, which is HH, and then create higher lows, which is HL. And also they create lower highs, which is an L and H, and also lower lows, which is L and L. But guys, note something. NB, the market doesn't move impulsively only. There are always corrections within the price movement or volatility. You must practice these phases so that they be registered in your subconscious mind. It's important, guys. They'll be easy for you to apply. That's the nature theory of what the strategy implies about, guys. You need to understand the nature theory about the impulsive moves and the corrections together with the formations or the structures that the market is literally presenting to us. So let's get back to the real markets to show you the true facts about what we mean by the nature theory of the market. Now guys, as we jump deeper into the charts, you can be able to see I'm going to explain quite deeper what we actually mean about the market theory, right? We're going to be looking at Euro USD. So what we mean by the nature of the market is that we know that the market needs to have an impulse move, a correction, which in the nature is forming something like a pattern, and then another push to the upside or neither to the downside. So it's all about understanding the market nature on what it presents, right? So let's look deeper into what's happening at the current state. As you look at this bidder price, let's just copy it from here, right? And then drag it right there, copy it aside, right? as we literally look closer to this, guys, you're gonna see what we spoke about, the market nature. We know after every impulse move there has to be a correction, an impulse move, a correction, right? So guys, the market becomes more beautiful because we understand that after every push, there's always needs to be an exhaustion. Prices can be overbought or oversold. We only need to understand the market nature that after every impulse move, we need to expect a correction. Corrections are phases whereby the market moves in slight candlesticks, or to say moves sideways, to show that the prices are literally breathing. They're taking a break from their impulse moves. So sometimes it happens that the market corrections confirm continuations or confirm reversals. So that's what we're gonna be dwelling deeper into this strategy. We're gonna be teaching you guys how to read in between the lines by literally understanding the pushes and exhaustions, or to say the impulse move and corrections for continuations or for reversals. So let's focus on a beta price right here for it to make sense. So as we copy the price aside, you're gonna see something, guys. As you can look, this was an impulse move to the upside, and then this was a correction, as you can see right here. Impulse move, correction, right? So let's cater for that beta price so that it can make sense. So as you can see here, we had something in nature of a falling wedge, or to say a descending channel. So in other words, we say, as you can see over here at the top also, we're also seeing something in nature of an ascending channel. So these guys are literally patterns that you're going to learn within the strategy as we proceed with the lesson. But however, we just wanted to make sure that, guys, you understand the market theory or the nature of it, that after every impulse move, we need to expect a correction for continuation or either for reversals. So it also happens on a bearish market. So in a bearish market, it happens in this sense. So in a bearish market, the prices would literally push to the downside, correct sideways to really form something in nature of continuations to the downside, or either form something in nature of reversals. So that's the nature of it. We know that, guys, after every push, we need to expect a correction. So corrections in this strategy is one of the most important things that we need to focus on, because that's how we capitalize on the markets, right? The reason why we capitalize on corrections, because you don't want to be caught up on the wrong side of the market, especially entering prices or entering a trade on impulse moves, because that's going to actually trap you on the wrong side of the market. The main goal, it's all about being profitable, but not being a market chaser. So that's it for the market theory, guys. You know, push, exhaustion or correction, and then continuation, or maybe push, exhaustion, which is correction, and then reversal, right? So that's what we need to understand. That is how the market nature is presented. So let's get back to the lesson. So guys, now we're going to be focusing on the market structures. Market structures are the overall view of a market direction. We have two types of the market structures, which is the outer structures and also the inner structures. These two types will help you easily read the markets, right? As you know, guys, the outer structure, we're looking at the overall bigger picture of what the market is presenting to us. But the inner structures, we're looking for far most deeper depth of what's actually happening within price action. Let's get to see in the real market what we actually mean. So guys, we're going to be making an example looking at GBPUSD, which is pound dollar, right? So in pound dollar, we're going to literally determine the outer structures before we actually determine the inner structures. So in this sense, you need to understand the fact that the outer structures, we're looking at the bigger picture, what needs to be in a weekly time frame or either a daily time frame. What's the bigger picture telling us? Are we on a bearish trend, or neither are we on a bullish trend? So let's cater for the outer structures. So as you can see right here, guys, we have an outer structure on a weekly time frame that has been respected quite a lot, guys. As you can see, this was a trend which was resisting prices. Every time the prices reaches this level, they normally turn. So as you can see also over here, guys, there is some kind of a trickling price action, which means the prices keep moving up, down, without any direction. Whether are we impulsing to the downside, or neither are we impulsing to the lower side, or are we correcting? So by understanding those key factors, this is going to make you understand the importance of literally having the bigger picture before dwelling deeper into the lower structures. So as you can see at the top right there, we have an overall structure, which is a resistance, and below it we can cater for here as this would be our outer support, which is a bigger picture, guys. Now the bigger picture of it, as you can see from this current moment, we had an impulse move, correction, right? Impulse move, correction, impulse, correction, impulse. Now the price is formed another pattern within a pattern. You're gonna learn about that as we move forward with this lesson, the patterns within patterns. So as you can see, this was an overall pattern, but however, we also have the inner structures, which is the inside patterns we experienced. Now we had a push again, this was an inner structure, we had a push again, and then this was also an inner structure, we had a push, inner structure, the push again, inner structure. So you're going to understand the key factors of this, guys, once we proceed with the lesson quite a lot, because it's going to help you to literally determine the opportunities within this once you understand the bigger picture. Remember, we all normally say that never go against the trend, because the most focus needs to be more on, guys, you need to understand what are you looking for when you enter into a price action. Are you looking for selling opportunities, or neither are you looking for buying opportunities? You wouldn't want to buy on a selling opportunity, or you wouldn't want to sell on a buying opportunity. So that's vice versa. Let's delve deeper into a lower time frame for you to see the inner structures. So we are in a daily time frame right now. So as we made an example, guys, at first, that there's gonna be structures within structures or patterns within patterns. So as you can see, we have an overall bearish triangle right now, which was contracting, squeezing price action within. Now, as you can look quite closely here, guys, this was also a pattern within a pattern, right? As you can look right there, remember, the bigger the time frame, the high confluence it has towards your analysis, the high probability it tells us that, guys, this is literally what's happening within the charts. We need to focus on it and literally profit from it. So as you can see right there, this was an inside structure. But also, if you look closely inside the structure, we have structures within structures within structures. So as you can see, this was a structure right there, which was a pattern in that sense. So we also had a pattern here. And also we had another pattern right there. So guys, the minute you learn these things, you're going to be able to read in between the lines of price action. It's very, very important, guys, that you need to understand these things. Remember, we normally say the market nature says after every push, there's always an exhaustion. So in a weekly time frame, there was a push to the downside, and then this was an exhaustion. But however, within this daily time frame, we also have impulse moves and corrections. So let's go on a 4-hour time frame to break down the daily time frame structures. So as we are in a 4-hour time frame right now, you're going to be literally able to see what's happening within price action. So as I said, guys, within this bit of price that we copied right here, there's going to be patterns within patterns within patterns. So as you can look closely, let's just say, guys, at this bit of price, right? Starting from over here, you're going to see that within this price, there was literally also actions that happened within there. As you can see, we had another ascending channel over here, another ascending channel over here, another ascending channel over here. And guys, like, these things are pretty important. As you saw, the minute it broke out of this structure, it came back to retest, forming a pure, beautiful bullish channel, or a bullish trend, or a bullish pattern, of which you're going to learn from it as the strategy continues. As you see, it literally pushed to the upside far most till that point. So these guys are the key factors you need to understand that will make you high profitable and understand the market nature. You need to understand how the market works for you to be able to know how to read between the lines and be able to take high quality trades. So this is what we need, guys, by structures. So we have the outer structures, and then we have the inner structures. As you know, the outer structures is what happens on a bigger time frame. The inner structures are what happens between lower time frames. So guys, let's get back to the lesson. Impulse and correction phases. An impulse move is one whereby the market moves quite strong or heavily in or on a direction, covering a greater distance in a short period of time. These moves tells you when the imbalance between the buyers and sellers is really strong, and there is a heavy participation from the intuitional side of traders. Logically, they are generally more volatile, and this provides us with great opportunities for more rewards with less risk, since the market will stretch more easily in one direction. But guys, remember this, no matter what, we want to be trading with these moves as much as possible, but let's not go against them. So let's delve deeper into the charts, guys, for you to understand the impulse and corrections. So guys, we're going to be focusing on USDCAD to explain the impulse and correction. So on a bigger picture, this is what we're looking for. This was an impulse move to the downside, and then this was a correction. This was an impulse move. Now this was a correction. But guys, within this correction, you can literally see that there were impulses and corrections, impulse, correction, impulse, correction, impulse, correction, impulse, correction, breakout with an impulse, correction. So the minute you understand this market natures, guys, it's pretty simple. Like, you're gonna even laugh with the chart and be like, no bro, you literally showing me an impulse move and a correction. Then that's when you fall in love with the markets. It's pretty simple. So this was an impulse move. As I said, this was a correction forming a bearish flag in a bigger picture, and then literally dropped to the lower side, forming another pattern right here, literally push to the sideways and impulse to the upside. So let's literally delve deeper into a lower time frame for you to understand. So as you drop it to a bit lower time frame, you're going to be able to see, guys, that sometimes there's what we call trickling. Trickling is literally when the market goes on one side for the longest time. It can be a lot of days, it can be weeks, it can be hours, or neither, it can be minutes. So in this instance, you're going to be able to spot that, guys, this we trickled for quite a lot of times, because this is in a daily time frame, right? As you can see, guys, this was literally, we trickled quite a lot. But within this trickling pattern, you're going to be able to spot that within there, we had patterns within patterns. As you can see, this was a pattern within a pattern. And then also right here, this was also a pattern right here, which was an ascending type of nature. That's why the market literally, when they broke down, literally sell up until this point. And then we also had something in nature of a correction right here, of which you're going to understand these things, guys, as we proceed with the strategy. So as you can see right there, so it's this, guys, when you're able to read in between the lines, you're going to be able to profit from the market. So explaining the impulse and correction phase. So this was an impulse, then this was a correction, this was an impulse, this was a correction, right? So you can see it trickled a lot. Impulse, correction, impulse, correction, impulse, then this was a correction, right? Impulse again, correction, now the impulse. So you're going to understand these type of natures, guys, which is going to help you to profit from the markets quite a lot. So taking it to the bidder price, explaining it in a sideways format, you're going to be able to spot that in a white chart, the nature of impulse move looks like this. This is one candlestick or a lot of candlestick pushing harder to the downside, correcting sideways, which forming a correction phase, then impulse again. Or neither, it can look like this, push to the upside, correction, forming something of this nature before actually pushing again. So impulse moves, guys, are literally those big movements that occur within the markets, and then corrections are those small phases that occur where the market has been ranging in between two prices but never breaks out or never exceeds or never decreases. So that's the correction phase. So in the nature of the market, this is how it would look like, right? As we shift it right here, you're going to be able to spot that, guys, here. This is a correction phase right here. As you can see, the market literally pushed harder to the downside, but now this is a correction phase of which the market is now starting to go sideways without any further direction that is giving us. Because if you look closely, this is what we're facing right now. We're having a resistance at the top, and then we're having a support at the lower zone. But however, guys, remember I said the strategy, you're going to learn how to use zones and also use the ray line. I prefer far most the ray line because it works greater with the strategy. So as you can look closely, guys, this is what actually happening right now. So this was an impulse move to the downside. Now it's correcting. That is why it's going sideways. Remember, in this instance, we say at the low we support, at the above we resist. So that's it for impulse move and corrections. Let's delve deeper to our lesson. Continuing with impulse move and correction. In other words, what we mean by this is, guys, in impulse move and corrections, we have pullbacks or retracement. Is relatively short-term movements of the markets in a direction opposite to the main trend. A correction will be a bearish or a correction will be a bearish in a bullish trend, while in a bearish trend a correction will be bullish. Corrections emerges as the market gets either overbought or oversold. This can be seen from reading in between the lines of price action. In addition, there is so-called horizontal correction, which also is referred as sideways market range. It takes place when demands for a certain asset or its supply balances each other out, right? So these things, guys, is the pure things that you need to understand, the pure characteristics of what's within impulse and correction. When a correction is over the price return to the initial trend, newbies are often advised not to trade counter the main trend, as such aggressive trading requires experience and psychological resilience. So that's it for impulse and correction. Now, moving to emitting or evolving of trends, basically. This is whereby, guys, you need to understand the importance of not forcing trends. This is whereby you go with the market flow by not forcing trends, catering for the most recent touches and not drawing in between candlesticks. The secret is, as long as it presents 2 touches, just know it's a high probability. But guys, for it to make sense about what is evolving or emitting trends, let's get deeper to the charts. So guys, as you can see, let's look at it. USD JPY right now will be a pure example to use the evolving type of nature. So evolving doesn't mean, guys, for an instance, let me just make an example. When you draw a trend from here to that point, literally crossing over other candlesticks, guys, it's literally wrong. You need to cater for the most recent touches. If it's 2 touches, it becomes a high probability. If it's 3 touches, it confirms to be an area of sensitivity. So making an example covering the overall picture we have, we are actually on USD JPY looking, or maybe we are ranging in between a bearish trend. So in this instance, you need to understand that, guys, catering for the lower zone, we also looking for something that merges the upper zone, which is what? Our resistance. Now let's drill deeper into what's happening within the outer structure we have built right here on a daily time frame. So on a daily time frame, guys, I'm going to literally show you something that's literally important to understand about the nature of evolving, or to say the nature of emitting price action. So we're going to take a bit of price, just cut it right there, right? So let's look at what's happening currently. Now, guys, this is a replay mode. So in a replay mode, it allows us to literally look at the bigger picture of the market. So literally, we're going to be playing this for quite a lot. So let's delve deeper into what's happening. So overall, guys, as you can see from here, let's just say this is basically a real market. So I wouldn't draw a pattern from here. But however, I'd literally cater these 2 touches. But however, focus more on what's happening when the prices are literally breaking out. Are we breaking out impulsively or correctively, right? So those are the natures you need to understand. But in this instance, this bit of price right here, we are breaking out correctively. Correctively means what? There's high chance for prices to form another pattern. So as you can look closer to it, this is basically, guys, an inverse head and shoulders. You're gonna learn about it as the price. You're gonna learn about it as the lesson goes by. As you can see, this was a head and shoulders. Now we're anticipating price to reach that toppest point, which is this current area, right? As you can see right there, we're looking at head and shoulders. So for me, in this instance, I'll say I'm looking for buying opportunities. What do? I don't just dwell deeper into charts. I need to literally understand what the prices are telling me. Let's go to a 4-hour time frame. As we go on a 4-hour time frame, you're going to be able to spot that we're starting to form a trend. In this instance, a trend would look something of this nature. So we know, guys, that we buy low and then we sell high. But within this pattern, we also having other patterns within. So let's actually look at what the price action would tell us. Remember, we're playing this as if now we're entering a trade. So as we move it forward, you're going to see as we move forward, the prices clearly don't make sense because they are ranging sideways. But however, FX code being FX code, we will be able to spot that this is forming a correction phase. Right? What do we do in the correction phase? We look for opportunities to enter the market. So for us, in this instance, we'll be definitely looking for buying opportunities, right? But we don't use market execution with this strategy. It allows you to wait for prices to come to you. So as we literally delve deeper into what's happening right now, let's play it a bit further for it to make sense. So the prices keep trickling. As you can see, guys, right now we are not yet triggered in. The prices keep trickling. So this is where now evolving comes in. Instead of drawing this trend line below or above, I'll actually emit the trend line to cater for the most recent touches, which will be the toppest of that point and also expanding to see if it's creating a different pattern or it's continuing to respect the one that we literally drew. But what do you see? It's literally creating another pattern. So let's wait a second to actually understand the price action. So in this instance, we will literally wait to see what happens. But however, capitalizing from trades, we would look for buying opportunities with the buy stop right there, catering the lower zone, and then looking for far most to go up. Looking far most to go to the upper zone. So let's wait for it. As we continue to play the price, continue to play the price, we are triggered in now. Do you see that, guys? As we are triggered in, we were able to spot that now our first pattern was in the correct one. We needed to evolve our trend lines, putting it on the recent touches to ensure that we capitalize from the trade. As we push further, as you can see, prices keep trickling on the lower zone, keep trickling on the upper zone. Now they come back, Prices literally keep playing, As you can see, guys, literally, if the prices reached this level, we could have put our stop loss on break even. That's the most important thing. So we put our stop loss on break even. Now we know when the prices get back, they triggered us into profit. So as you can see, the prices literally come back now. Now we start to what? To evolve again. That's where evolving comes in. So we see the channel is, we see now that the pattern was respected for a short term, but however, in completion of the previous trend or the previous high. Now we evolve. We put our high right there. We put and cater for the recent touches. You see, now as we evolve, we're going to see that this was our first touch, second touch, and this is our third touch, respecting a different trend. So as you can look closer to the markets, you're going to be able to spot that. But now we are moving on a different trend. That's the most important thing, guys, about evolving. It teaches you not to force trends. You consistently look at the different charts or to look at different patterns the far most as you go. So the nature of it, looking at in a white chart, is going to be something in this nature. We know after every impulse move, there's a correction, right? Impulse. So what happens when we see a correction? We're going to start now to say the market has established a new trend, right? Which we're going to cater for this trend right there. But as the market corrects within the price action, people are going to anticipate that when the market reaches this point, it needs to buy. But however, you need to be careful. Sometimes the market decides to break the structure or neither respect the structure. But in this instance, talking about evolving, the market decides to push to the downside, push. What are you going to say? Are you going to say it's a change in price action? Did we break out of the structure? Now we need to look for something different? No. Focus on how the price action is breaking. Are we breaking out impulsively or correctively? In this instance, we are breaking out correctively. This means that we need to evolve our structure to literally cater for the most recent touches. We're going to say from here now to there. So as you see, the market might continue to do so. It's telling us that it's preparing for high buying opportunity and it decides to push up. A lot of people, they tend to get trapped in the wrong side of the market because of having a stigma or having fixed mindset of their analysis, saying if it doesn't buy here, then the market doesn't favor me. No, guys, follow the market and never go against it. Let's get back to us. So guys, I hope you understand those are the key factors or the key characteristics of the new advanced FX code strategy. Once we learn this, we're going to be able to spot good opportunities within the markets. Now, let's delve deeper into the patterns that are included on the strategy, what we look for when approach the charts. Guys, make sure to take notes, make sure you understand these patterns, because guys, this is the main key factor of the strategy. What we just learned right now is literally the basics of what's needed for you to trade the strategy. But the patterns are some things you need to know subconsciously, so that every time when you see price action, you're going to be able to say, this is a bullish channel, this is an ascending type of nature, this is a bearish channel, this is a descending type of nature, this is an expanding channel. Guys, you're going to learn them quite a lot. Fell in love with them. See you on the next episode.
Ladies and gentlemen, I greet you all. Now I'm gonna then move my phone to portrait version. So then I'm gonna zoom in and then start drawing my diagonal supporting trend line. I've drew it, and then I'm gonna draw my diagonal resisting trend line. Yes, I've drew it again. Then from that point, the second step that I move to is what is going to a line graph. On a line graph, that's where I then fix all the mistakes and ensure that everything is what is catered for. So yes, everything is catered for at this time and moment. I know that like my trend lines are exactly on point. I then do what? I then move to 4 hours to see on 4 hours if I was drawing a right thing or I was drawing a wrong thing. Then on 4 hours, I have to do some few adjustments. Here I am doing few adjustments, making sure that I cater exactly where my trend line attached what the whole overall structure. So okay, there you have it. So from that I then move to Japanese candlesticks and check if I have my entries, but I can never have my entries before I do what? Before I draw my levels. So I'm seeing that there is a strong level here, and then there is another one here, then there is another one here, another one here, and the final one is there on top. Here's the final one there. So after having my levels, I zoom in, I check whether I'm looking for continuations or I'm looking for the retest before continuations. At this time, I can already spot that I'm looking for continuations, but then I'm seeing that there is another diagonal resisting trend line that I can spot here. I then draw it, and I can see there is another supporting there is another supporting diagonal trend line here. I can literally change the colors to make it easier for our students to see that I'm now on another trend that I deem very important for you to actually know. That's the reason why I have different colors, so that it's going to be much more easier for you to actually analyze in a better way. So now I'm already seeing that the rest of the other trends are not as effective or are not as important as this one. So meaning to say what? My main focus is now gonna be on this one. So I can already see that there is an important zone here of which I'm gonna highlight right now. So from this important zone, I'm looking forward for reversals going to retest on this other previous zone, and then from there I'm looking for continuations moving further up. But then there is something that is called a point of confluence, of which I want you guys to get to know about that from the strategy. Point of confluence, it's where all my trend lines that I've been drawing, they agree to show me that they are reversals or continuations from that particular point. It forms part of the trends in trends. However, that's where I see that there's a lot of action that takes place from that point at the current situation that actually helps me to actually do what? To do sniper entries at that time. So here there is what we call a point of confluence here on this position, because of what? My main trend met up with what? With my trend which is within a trend. So both of those two trends, they met here. So here there was a high probability for what? For buying opportunities. And also let me continue to say there is also a high possibility for what? For selling opportunities at this position here, because I see that there is something that is called a point of confluence. That's where the main activity that was taking place at this point here. Also, we are expecting it to actually take place here. That's why I'm saying I'm expecting a reversal from this point, not a continuation, because I'm expecting it to actually do what? To go down when it gets to this point and then continue moving forward. Ladies and gentlemen, I'd like to take this opportunity to greet you all and welcome you to the 10 steps that you follow every time when you analyze. So these are the FX Go 10 steps that you need to follow every time when you analyze. Without wasting any of your time, let me start with the first step. So the first step is that you move from whatever time frame that you were in to a daily time frame. Whichever time frame that you were in before you logged into your MetaTrader 4 is not important. You then start by actually doing what? By moving to a daily time frame. The second step that you then follow is that you move your cell phone to a portrait orientation so that everything appears clearly. What is a portrait orientation? It's that horizontal way of seeing like your cell phone in a horizontal manner. The screen becomes like much more bigger and better and easier for you to actually utilize. The third step that you then follow, you look for an overall direction. Remember, you're now in portrait orientation. You look for an overall direction, whether it was the buys or the sells. You then decide whether you are looking for bullish or bearish opportunities. Number 4, you start drawing your diagonal supporting trend line and your diagonal resisting trend line. And then the fifth step that you then follow, you move from using Japanese candlesticks to using a line chart. Number 6, you fix your trend lines and make sure that everything is catered for. Number 7, you move to H4 from day 1. You remember you were on D1, now you move to H4 to do adjustments again and to ensure that everything is catered for. You do these adjustments again and then you move to Japanese candlesticks again to start looking for entries. When you are now on step number 7 on 4 hours, that's where you start looking for entries. Which entries am I gonna be taking? On number 8, you then draw your levels or zones or your horizontal support trend line and start your resisting trend line. Number 8, you then draw your levels or your zone. Your zones are your so-called horizontal supporting trend line and your resisting horizontal trend lines. So those are your levels, which are then your zones that you then start drawing. Number 9, you decide whether you found your entries or not. If you haven't, you then move to a smaller time frame, which is a smaller than 4 hours. It can be H1, M30 to M15. Your H1 means what? 1 hour, 30 minutes, as well as 15 minutes. You then decide whether you have found your entries. If not, you then move to a smaller time frame, which is smaller than 4 hours. It can be H1, which means 1 hour, M30, which means 30 minutes, or 15 minutes. Number 10, you then move to a smaller time frame to decide where is your stop loss and your take profit.